Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing a friend of mine, Benjamin Demase. How you doing today, Ben?
I'm doing very well, Daryl. I hope you and the listeners are as well, from wherever they may be tuning in.
Yes. So they refer to you as the Royalty King, not by accident, right? So I want to jump into the royalty and streaming space and get your thoughts on this particular sector. I know we've covered it extensively in our last interview, but I mean, the metals have had a significant sell-off. Some of these companies, Gold Royalty, Wheaton, Cisco Royalties, and many others have sold off significantly alongside the miners. But it's kind of interesting because the miners are a lot more riskier and have more jurisdictional risk and all of these different things. But, to see these high quality companies selling off, it speaks opportunity to me, but just want to get your take on it.
Sure. So I guess we will start with the recent price action in terms of the precious metals market. We had such a phenomenal year last year. I think people kind of got accustomed to such a wild move in a relatively large and inert market such as the gold market, which is not always the case, happens very rarely in history. From what I've been looking at, it looks like a few central banks around the world needed to sell some gold to make up for liquidity needs that they had, which were pressing. And I think that really touches on a key aspect of liquidity versus solvency. So I don't think that was what they wanted to sell. I think that the Central Bank of Turkey had to sell a little bit of gold in order to meet their foreign denominated debt. And we saw a sell-off. I would consider it a fairly healthy correction given price action over the last 12 months. And I've done something that might make a few people angry on VRIC. I've sold some of my gold bullion. The reason I've sold some of my gold bullion is that I think that I want to get even more aggressive on the gold play looking out towards the end of the decade. So I've been buying and accumulating gold since it was, I think, about $18.50, something like that per ounce. So I've accumulated some profit. I've left the profit in there. Okay, so I have a free carry on that. And I'm using that initial seed capital to get more aggressive on an expected gold move using certain option spreads and adding to the royalties. And I think that it makes all the sense in the world if I really believe in terms of the thesis of where gold's going and where it has to go given deficits and spending. Then having some spreads that will give me a 5 to 6x payoff with an average break even of gold at $5,000 an ounce is a really, really, really attractive risk reward. So now I'm looking at leverage on gold. And you mentioned the miners. A lot of people think gold miners will give you leverage on the action. They may, but there's all sorts of risks associated with that. So I tend to look at, if I want derivative plays on the metal itself, I'll either look at options or I'll look at the royalties, which I've been talking about for quite some time. Something that's might be interested, I published a chart, I think it was 2 days ago, measuring certain companies divided by the commodity which they sell. So gold royalty you mentioned, so I'll mention that. It's a good example because it mostly is a gold royalty only focused company. So they do have a copper stream and some other bits and pieces, but only over 90% of their revenue is expected to come from gold itself. So it's a good example to take gold royalty and measure it relative to the commodity which it sells. Of course, that's gold. And would you believe that gold royalty has done exceptionally well over the past sort of 12 to 18 months? But if you measure it by the commodity itself, it's actually even cheaper, to the tune of 70% over the last 5 years when it first IPO'd, I think, in 2021. So I thought that was very interesting, all coming down to what your thoughts are about a given sector. If you've got an investment thesis, how is it that you want to play it? I've decided that I'm very, very happy leaving just my profits where they are. And then if I believe in the thesis enough to buy the gold for the future, now I have the chance to really get some leverage on that by taking that seed capital out and deploying it in ways that I've mentioned and share with subscribers.
Yeah. Thanks for sharing that. I've actually sold some physical silver to park into some of the silver miners on weakness, and so I have sold some physical metal myself as well. I'm curious in when you mentioned the royalty space, so obviously gold royalty being cheap relative to the price of the commodity. What do you think about some of the bigger companies? So like obviously we've talked extensively about Wheaton and such. With Wheaton, I wasn't as thrilled with the deal, but I want to make sure I'm understanding it correctly. So they recently had they bought the Antamina mine stream from BHP, and it was a multi-billion-dollar deal. And so, I was kind of like, okay, is this just like they're not going to get the same type of deals that they had during the bear market? Is this that type of thing, or was this a bad deal? And so I've been wrestling with that a little bit, and curious in how you've processed that deal with Wheaton.
Well, I must be honest, I haven't paid an awful lot of attention to it. I trust that Randy and the team at Wheaton. In a funny way, I would suggest this is an example of Wheaton doing similar things to what I have been doing, in the sense of trying to get leverage to future pricing. So let's take a step back. Wheaton, I believe, has done this based on what looks like a fair value to slightly expensive deal today. But if you look out into the future, what they expect the silver price particularly to be, then I think will start to look cheap on the back end. So similar to how the market was, I suppose, punishing Franco-Nevada over the last 5 years, not really understanding the nuances of the direction that Pierre and co wanted to take the company. So they decided to put 2/3 of the book into non-producing assets, and assets that won't really be brought into production until a much higher gold price at the time. That price was somewhere between $4,500 per ounce. And of course, now retrospectively, they look like geniuses, because it's with everything that we have in terms of a global macro setup. These are very far out of the money call options, and I suggest a very similar thing has happened with the Wheaton deal. The difference between this, by the royalty and streaming financing structure, versus an explorer or a developer, is that these are free carried call options. They don't have any capital exposure to the development of these mines into the future. And I think that is the key distinguishing feature of their particular business model. So maybe a fair to slightly expensive deal today turns out to be a genius long-term call option tomorrow being used very loosely, might be 5 years down the track. And with that in mind, what is the cost to these companies today and ongoing? Is really, I think, there's not a lot of expenses in terms of having to maintain this call option. So I think that they can afford the theta, or the time decay, until these options really start to kick into the money at potentially higher volumes than calculated today, and almost certainly higher pricing.
Yeah, for sure. Yeah, that's really good stuff. Okay, so I want to cover one of your other investment theses. This is the exchanges. So you had a really brilliant piece on the exchanges, and actually quoted your analogy on David Lynn's podcast, owning the roads and the toll booths instead of owning the cars. And so oftentimes when people are buying cryptocurrencies, they're buying individual cryptos versus owning like some of the infrastructure that allows these cryptos to be traded, or some of the banking banking structure that allow the cryptos to be traded and such. And so I want you to touch a little bit on that thesis, and I encourage the audience to subscribe and read that brilliant piece that you put out. What are the benefits to owning the exchanges versus owning the individual equities or individual cryptos?
Oh my goodness, it's such a topic. Thank you for mentioning that. There's a free white paper available, so it's not behind a paywall or anything, guys. You're more than welcome to read it. I guess I'll start with let's understand the business model. Isn't that crazy? We live in a world of finance, capital markets, news, 24/7. Everyone talks about the numbers in terms of the deal made, the PE ratios, the quantum valuation, and not many people really take the time to understand the ongoing operation. So the exchange business model, I believe, is the preeminent business model that there is, that I know of at least. They even eclipse royalties to a certain extent. They have something that I've called structural alpha, meaning they can outperform the market purely by the privileged position in which they occupy. If you want to imagine a very simple analogy of the casino, for instance, so people taking individual investment bets, let's say, on crypto, any other asset at the table, they would be analogous to the gamblers. So two gamblers at the table, one goes long a commodity, one goes short. Eventually there's a winner or a loser. One buys a crypto, they either make money or they lose money. Okay, there's a buyer and there's a seller. In any case, the transaction that occurs will incur a fee. Sometimes it will occur lots of other things as well, which we can talk about. But I suppose the main thing to understand is that the house always wins. And the house in this case would be analogous to the exchange. So one thing I suppose that really stands out from this type of business model is that they are completely price agnostic to the underlying individual bets or the movements of the stock market up or down, a commodity up or down. As long as there's volume being transacted on the exchange is taking their piece. And so I think this is the cornerstone of that particular business model. And these business models have been amazingly resilient. The first exchange, believe it or not, was back in I believe 1602, if I remember correctly from the piece, which was the Amsterdam Stock Exchange. So if you think about it, how many business models can survive centuries and continue to be prosperous and benefit, being an anti-fragile business in terms of benefiting from volatility? So many businesses right now, with everything that's going on in the world, are being completely disrupted. And yet, what does that incur? It incurs people, for instance, in the oil market. Shout out to all the people trying to hedge their oil positions. If you work at an airline, if you're an import-exporting business, if you're involved in shipping, God love you. All that involves hedging, futures contracting, derivatives being bought, sold, orders being placed, transaction volume increasing in a time of volatility. And what does that incur as far as the exchange is concerned? More and more fees. So I guess that would be considered the cornerstone of the exchange business model. And not to be slept on is the fact that it's an anti-fragile business in that it actually benefits from increased volatility without taking any of the underlying risk. In terms of direction, they incur regularly 65 to 70% net margins. And the capital light aspect of the business means that it doesn't have to necessarily invest in larger and larger infrastructure to accommodate for these volumes. It's just simply setting up the software, setting up the trading algorithms and everything involved from the IT side of things. And they have a relatively fixed cost base. So they can maintain and compound their returns on equity over time. Happy to talk about any other aspect of exchanges that you might like, but it's a long paper. It goes all the way back to 1602. So I'm happy to take the discussion wherever you would like in terms of exchanges. But I think that I can't believe, I guess, the complacency around the business model, especially when you consider that in almost all the cases in which I've looked at, exchanges have outperformed their underlying index, which is truly phenomenal. And it leads the reader to ponder whether exchanges might be better than buying a passive ETF in terms of not only performance, which they have outperformed their underlying index, but also getting true diversification, which I don't think most of the main indices today provide as they once sought to do.
Yeah, yeah. I do want to touch on the CME. That it was pretty funny because that was one of the exchanges, and even in the gold and silver community, stacking community, where you have these futures contracts and such being being traded and shorted, and there's a lot of speculation on manipulation and everything. And then I remember you had, I think the last. Shutdown or overheating that the CME had, you had put out a post on X, and you were like, "Oh yeah, well, those that own the CME stock still benefit, even when the systems are overheated and such." Let's touch on that.
Yeah.
Yeah, let's touch on that.
In one sentence, my friend, the house always wins. And here's something that I encourage people to do, and I'm sure that 99.9% of people will not do this, which is actually read the rules of engagement. They are the rules, essentially. So all these people complaining about the CME, these people complaining about the LBMA and so on, I think that they're going to be the next Hunt brothers. Guys, we just never learn from history, okay? When things really start to get out of whack, they can and will close the exchange. They will settle you in cash, and there will be precious little that you can do about it. So that, I guess, in a nutshell, I'm conscious of not talking too much, is really what's going to happen. It doesn't mean that people won't profit. I mean, you can make your paper profits, and there's a legitimate, for those that follow the volume of metals, the Andy Schechmans of the world, the Bob Colemans, tracking the physical volumes of the metal, they're certainly correct in terms of there being a tighter and tighter squeeze with people standing for delivery. But in terms of you profiting from that necessarily, at least from the metal side of things, you don't expect when if you do reach this stage where there's no more silver in the vault and you stand for delivery with your contract, you standing there with your little, I don't know, $1 million, $2 million worth of physical demanding it, they're just gonna settle you in cash. Okay, let's just be clear about that.
Yeah, for sure. And I'm looking at the. Let me actually share this chart really quick. I'm actually looking at the chart of CME now. It's performed pretty well over the last. If we're looking at the last 5 years here, obviously it's going under some pressure here recently, but over time, like it's performed pretty well. So if you own the house that hosts the contracts and the contract trading and such, you did pretty well if you're able to hold through that volatility. Yeah,
absolutely. I would encourage people to switch off from price and just go and look at the volumes traded on basically any commodity you like, basically any asset class that you like over the last month. And when you see, we mentioned the gold sell-off over the last few weeks, have a look at the volume flows in and out and in and out. And this kind of, another good aspect of the exchanges, they have this non-correlated source of alpha. So their ability to provide alpha to your portfolio is not necessarily correlated with anything that's happening in the world. So when you have a downwards S&P market, let's just say, so broad sell-off or bear market, volumes go up because people have to sell. And then what happens? The ETFs have to rebalance. Each of these events incurs turnover and transaction for the underlying exchange. And so right when you might need it, if you're a broad equity investor, let's say, and the main part of your portfolio is really under pressure, well, the CME group, the Intercontinental Exchange, the NASDAQ even, they're benefiting from all the volume of these transactions. So it's a nice place to be, somewhat similar to the royalty thesis, which, for instance, if you're a landowner and you have oil royalties, even in a down market, you are still making some money, whereas the producer is losing money hand over fist, and the oil service co is wondering if they're going to be able to make it through to the next up leg in the commodity cycle. You are exposed in that case more to the underlying commodity price more than you would be for the exchange, which is truly agnostic, but it does provide somewhat more of a cushion, which again is why I've spoken and written and researched so much about the royalty business model over the last few years, and the exchanges are tied into that.
Mm-hmm. Got it.
George and his team, a 16-year VRIC employee building some of their largest mining operations on the planet. We started a drill campaign, from the drill campaign moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
So since I've been knowing you, you've been invested into the oil sector, either by extension of, land royalties, whether that be, Texas Pacific and companies like that, or even to offshore oil. I think you've been into tankers for a while and everything. So I'm curious in just your overall thoughts on oil at this point. I mean, obviously we're in a global conflict and crisis that's impacting the commodity that's essential to the lives of billions of people. And so just curious in your thoughts on the oil sector currently.
Yeah, again, to keep things to one sentence, it really comes down to, is the strait open for traffic or is it not? It really is that simple. If it remains obstructed for another 1 to 2 weeks, the world's in for, I think, a lot of pain, from my understanding. I'm back in Australia now for a few months, so I'm being very careful as to how much I use my car in terms of the diesel components. And so if oil stops, everything stops, basically. And so what does that mean? It means some of the people that have been more aggressive buying lower quality businesses, the service companies, for instance, they might do extremely well. I have done well in the offshore and services space, and now I've kind of lightened my exposure, possibly to watch the stocks go further up. It really doesn't bother me because I've done what I needed to do. And if WTI, which currently trades at close just under $99, if that does do something silly like get to 150, 200, 250, and that will be very painful, and it will set a trigger for demand destruction, meaning that obviously the same amount of buying cannot occur at 250, let's just say, versus 65, which is where we were, only a month ago. It seems like a long time ago. And so eventually you will start to see the other side of that hockey stick. Now, I think given the estimated volume disruptions, that oil can remain elevated higher for longer, as they say. And so we'll go through, it looks like we'll go through a situation where most of the producers will do well, the service coast will do well, and incentive to drill will obviously be an awful lot higher. And eventually that capital cycle will turn. That might take quite a few years, and then I believe that we'll start to have really the downside on the other side of this. I have no idea how long that might take. It might take a few years. All I know is if I position myself intelligently via land holdings that have mineral rights and royalties, then in an up scenario and a down scenario, I'm still going to do just fine and compound over the long term. And to kind of wrap this segment up, I would say that if you're in West Texas right now and oil is not quite double, but it could well be double than where it was last month, are you more or less inclined to start to increase your production? I think that question answers itself. And so it leads nicely into one thing that I've been speaking about for years now, and no one seems to want to pay any attention, is the reduced water associated with that drilling. So if you believe that oil prices are elevated, and that logically follows that more drilling and production activity will occur, then in the Permian Basin, that means a lot more produced water. So happy to talk about that or answer any other question.
Yeah, let's jump into that. So water, it seems like it's not the most sexiest of topics, right? Which benefits investors like us because we're able to position ourselves early in something that we believe that can, perform well over the next, 5 years or however long. So what's the basis of this thesis on produced water related to oil?
Sure, and it might not sound sexy, but if you believe in AI and that's all the sexy trade at the moment, then there's no AI without the water, which I'll get into as the second half of the thesis. So I guess the base case, the rock solid underlying feature of this thesis is that the Permian Basin produces roughly 22 million barrels, and one of the most prolific sub-basins, if you like, is the Delaware Basin, which produces, let's call it 3 million barrels of oil a day equivalent on average. Now, here's something that people have to understand. With the oil fracking in the shale basins, that requires a source water. Okay, so companies have to buy the water. They buy it from the companies that I own, Texas Pacific's, land bridges, and so on and so forth. And then they fire this water at the rock. And forgive me for all the geologists and the petrochemical engineers out there, I'm doing you a disservice, but I'm speaking very basically and reductionist. From firing the water, fracking at the rock, out comes all this oil and water mixed together. And in the Delaware Basin, for every barrel of oil equivalent that comes to the surface, 4 to 5 barrels of highly toxic produced water, it's called, is rising to the surface along with it. This is a nuisance product. It must be dealt with. And it's not the type of stuff that you want to drink, Daryl. So if you think about seawater, for instance, this stuff is about 10 times more salty. It's also got heavy metals. It's got all sorts of different toxins in it. You really don't want to be drinking this stuff. You cannot reuse this stuff straight away for fracking because you'll corrode the equipment, it'll clog up the meshing, and so on and so forth. So it must be treated to a certain standard before you can reuse it in the fracking process. And over the last few decades, what has been happening is that the producing companies, the Chevrons of the world, let's just say, have paid a third party to dispose of this water. Okay, it's a nuisance, they've got to get rid of it. Going back in the early sort of 2015, 16, 17, you could pay a rancher 5 to 10 cents a barrel just to inject it into their land, and the problem was solved. The problem with that is today you really can't do that because the available pore space has been taken up. We had, unfortunately, an incident where they miscalculated, they injected water, and out came this like massive geyser. They were causing seismic activities, and so there were all sorts of complaints. So last year, Texas Railroad Commission has really, really clamped down on the practice of disposing produced water. Okay, so we're at this point where you've got all this produced water and you need to be able to dispose of it. Otherwise, you literally cannot produce the oil. Okay, there's no one without the other. This has led to a multi-billion-dollar opportunity in the basin for companies that are willing to invest in the disposal, the treatment, and the transport of this water. Okay, so 13.5 million barrels, let's just say, of produced water per day. You've got to find a home for that. Going rates now, instead of where they were a few years ago, 5 to 10 cents, are now more like 75 cents towards the dollar, and purely for transport processes. So if oil production is to continue in the United States, and the Permian Basin is the heart of that production, and the Delaware Basin within that, you're going to see, you're almost going to see water as a derivative trade on oil. Okay, and obviously viewers can think about it for themselves. This is a volume sensitive market. Again, it doesn't matter necessarily what the price of oil is. You're always trying to get rid of these sort of 4 to 5 barrels worth for every barrel of oil produced. Okay, so very, very inelastic demand source, and not too many players that have the capability to dispose of it or transport it. Right. Any questions so far?
Man, it sounds very, very interesting because it's a necessary component of the chain, and you can't have the one without the other. And so, I'm curious as to, which we can get to this later, like how many companies are out there that have exposure to this business model that's so critical to the industry, which we can get into later after the AI side of things.
So let's talk about AI. We've seen AI kind of reach its limits close to inhabited areas, let's say in municipalities, and that's for various reasons. The data centers require their own power plants, and people are making all sorts of noise as to the type of fuel source that will be used to power these power plants to supply the electric power to the data center. Is it going to be coal, natural gas, nuclear? In the US, it's not going to be coal because it's politically inexpedient. Nuclear is a good idea, but it will take too long necessarily to build. But what the US is blessed with is abundant, cheap natural gas. So if you look at things from a Google or a Meta's perspective, they need their databases and they need their data centers in places that have access to the right amount of land. They need cheap and abundant energy supply via natural gas, and they need an awful lot of water. So in the most recent research paper that I've done, which I'm happy to make available for the listeners as well, I take the case of a 1 gigawatt data center, so 1,000 megawatts, okay? The minimum scale campus for hyperscale functions, okay? These things, without going into too much detail, you've got a data center. Those chips themselves need to be cooled or overheat. Their power is supplied by the power plant. They can't plug into a municipal grid because they'd crash the grid for all the citizens. So they need direct behind-the-meter access. So where's a perfect place to get your gas? Out there in the Permian Basin where there really aren't a lot of people and there's an awful lot of cheap gas. Regardless of the fuel source you use, to make electricity, you need an awful lot of water. You need to heat the water, and that water will make the turbine spin to generate electricity. But what happens between the heating of the water that makes that turbine spin, and then what do you do with the residual vapor? You'll remember from your year 9 or 10 science that particles respond to gradients. You can have pressure gradients, you can have temperature gradients. In this case, what makes the steam from the water boiled move through the turbine to create electricity is a temperature gradient. So we have a cool environment on one side, we have a hot environment on the other. Water travels through, spins the turbine, and now you've got this steam on the other side. So what do you do with that? Well, you need to cool that to turn it back into its liquid form to repeat the cycle. Now, when this happens, unfortunately, you can't hold on to 100% of the initial volumes. You always are going to lose a certain amount of volume as a result of evaporation. And when you're thinking about a data center at 1 gigawatts, that water volume withdrawn and consumed works out to be somewhere near 24 billion liters a year. Okay, so for you Americans, that's roughly 147 million barrels per year of water that you need to find. And so this leads us to an interesting junction. We've got all this produced water that no one knows what to do with, and you've got these data centers that are coming out to West Texas that need an awful lot of water. And so this thesis beautifully combines the two problem sets into an opportunity. Obviously, you can't take the same produced water, which is highly toxic with dissolvable concentrates, and throw it straight into the power plant. You need to have that treated. So you need to have it collected, transport, treated before it can be sold to the data centers. Okay? To cut a long story short, the blended pricing...
Really quick.
Sure.
So companies can... So I imagine that an oil company with the produced water, they have to pay the company to come take the water,
Correct.
treat it and such, and then the company can use that same water and sell it to...
Correct. That is the opportunity. That is the problem being solved and the opportunity being created. And using different engineering cases and different pricing to transport and treat that water, I think in the absolute most conservative base case for for that one power plant, I think your water bill to run a 1 gigawatt data center is going to run close to $265 million per year. Okay, to give you an idea. Now, here's the problem, Daryl. If you're Google and your Meta and your whoever else, Oracle, that have got these data centers, some of which are actually being put in at 7, 8, even a 10 gigawatt hyperscaler. So obviously you just multiply the millions of dollars needed purely for the water alone. Are you going to accept any downtime in the data center? So if the power plant goes down, are you going to accept your data center being offline for 1 or 2 days or a week? No way. These things cost so much money to build. So what do you need? You need a second power plant in the background. All these power plants will eventually need scheduled and possibly unscheduled maintenance. So you have to build the CapEx for 2 power plants. There's debate as to how much the second backup plant will run. Will it run 100% of the time, so there is zero downtime? Will it be sort of an 80-20 scenario? I explore these calculations in the report. Either way, we take this into account and we can almost double the water usage, double the opportunity set for the companies that can provide this need to the data centers. And the one final factor that needs to be taken into consideration is this gets you to a certain point in the calculation, but if you understand the electricity engineering side of things, if you've got a 1 gigawatt power center, or power plant, I should say, to get it to 1 gigawatt nameplate capacity, you need more than 1 gigawatt's worth of power. Okay, so you need to draw 1.35 to 1.58, depending on the calculation, depending on the expert you listen to. And that, of course, requires more gas and more water. So without going through all the numbers, because I know it's hard for people listening to keep numbers in your head without the figures in front of you, I think there's a case where this 1 gigawatt power plant, when you take everything into consideration, might run more like $420 to $780 million per year purely for the water alone. So that's the size of the prize. And when you consider these data centers already being approved out in Pecos County, there's one for 6.7 gigawatts. That's an awful lot of water. It's an awful lot of revenue opportunity that is somewhat speculative, but when you pile it onto the base case that I began with, being the produced water, no matter what, needs to be dealt with and treated, this is where I think there's a multi-decade, multi-billion-dollar opportunity that still I don't hear many people talking about, and they should be.
Wow. Okay, that sounds like an amazing opportunity. How many ways can people play this trade? I mean, I don't know how many of these companies actually exist. I just know of the one that you have written up in your writings. Yeah, are there a lot of ways to play this, or what?
No, not many ways at all. And when you think about it, the volumes needed require a certain amount of investment and underlying infrastructure. So you can't just, if you're a Chevron or an Occidental, you're going to need someone that can guarantee the volumes, okay? You're not going to look for the cheapest operator necessarily. You need someone that has the land, that has the pipelines, the permits, and the ability to dispose into pore space and or the ability to treat the water for other purposes, one of which is likely to be data centers in the future. So who owns a lot of land out there in West Texas? Who has the piping and who has the pore space to inject the produced water? There really, as far as I know, only sort of 3 companies, given that the one I owned last year got bought out. They would be Texas Pacific, okay? They would be Landbridge, which owns a lot of surface acreage and pore space. And then there's Landbridge's sister company, Waterbridge, which are focused on pipeline and transport solutions to take the water to those injectable sites, which are owned by Landbridge. And what do you know, Daryl? The surface acreage on which the water bridge pipes run are owned by, you guessed it, Landbridge. Okay, so this 5-point energy family of companies, Landbridge, Waterbridge, Powerbridge, and whatever else David Capobianco will spin off and eventually list, I believe are the principal players, the first movers in the space. There was a company, Aris Water Solutions, that was focused on this, which I owned last year. They got bought out by Western Midstream Partners. So they focus mainly on your traditional oil and gas midstream space, but they do now have exposure to the water thesis. And for more conservative folk who don't want to do an awful lot of work, Devon, the oil and gas-focused giant, own, I believe, roughly 20% of Waterbridge. So you could get some indirect exposure there, and you could get a little more talk on the US gas space. Those are the main companies that, at least that I'm aware of. There are a lot of other royalty companies in the space, obviously. However, they don't necessarily have the same monetization ability when it comes to water or transport easements. So Texas Pacific, Western Midstream, and Landbridge, Waterbridge, anything that comes out of the 5-point energy space has been the main, they've been the main players in terms of first mover advantage. And in a beautiful scenario, these companies or trusts are royalties and they experience the beauty of the capital light hard asset business model. They own the infrastructure, and then they collect fees on the transport activity that occurs. So for every barrel of water that Waterbridge disposes of, treats, they get a clip of the action. For every pipeline, telephone line, road, easement that goes across Texas Pacific land, some of which may be Waterbridge or other piping companies, Texas Pacific gets a royalty. They don't have to contribute to the capital costs of these things. They just simply own the land and are compensated thusly. However, it should be mentioned, I suppose, that Texas Pacific has a sub-branch that I believe they're called Texas Water Resources that are engaged in R&D for the treatment of this produced water. So they're working in concert with Bolt Energy. You remember Eric Schmidt from Google. He's gone and started his own data center company, for want of a better explanation. And they're working very, very closely with Texas Pacific on joint ventures. So all roads, water, oil, and AI lead to the Permian Basin, as far as I can see.
Okay. And so for these companies, that treat water and such, what's the scalability like? Because I imagine, we're just talking about the Permian Basin, and this is needed in, Canada, is needed in South America, I'm sure. And so is there scalability on that arena as well?
Well, there will be. It's a little different when you start to compare geographical locations. Don't forget the cooling systems can change as well. So if you're out in West Texas, air cooling, for want of a better phrase, is not really going to work if you're in the middle of Texas summer. If you try and air cool your plant or your data center, it's not viable. But in a colder environment, perhaps more of that could be the case. So there might be more or less additions to the water bill depending on where you are in the world. Mm-hmm. In South America, you have a lot of geohydroelectricity. So those, and you have running rivers through which you could take that water that I mentioned, boiled, pass through the turbine, and instead of using these condensating cooling mechanisms, a water tower, you could actually run it through a river. So you would lose far less volumes. Now there's environmental considerations and there's other efficiencies to keep in mind, but it won't necessarily look the same in other parts of the world. I think that's the main takeaway. What will be constant is you'll need an awful lot of electric power, and hydrothermal energy, whichever fuel source you use, you'll need an awful lot of water. If you use nuclear, you'll need more water than the gas case. And if you use coal, you'll need an awful lot more as well, simply because you can't turn on and off the heating mechanism. If you stop the heating mechanism in a coal-fired plant, well, it still takes time for the coal to cool down. So you're going to be losing some efficiencies there.
Okay. Yeah, that's amazing. Sounds like an amazing opportunity. I encourage everyone to go check out the Royalty King Substack so that you all can check out the write-ups on this. And then you mentioned, being willing to give the audience a report. So is that a link that we should provide, or what are you thinking there?
I can give you the link to the PDF. If you're interested in the exchanges, obviously the white paper is on the Substack, but it's freely available. Anyone can read it. And I suppose to put everything into the analogy of one that you mentioned, the toll roads versus the cars. If you own land and water infrastructure in the Permian Basin, you can charge an unavoidable toll on all the oil production and water treatment and the water that will be eventually necessary in the data centers. If you own an exchange, you own the highway through which all economic activity in the capital markets must pass through. So that's a nice situation to be. And if you own a simple metal or mineral royalty, anything that happens in terms of production activity on your land, you get a toll from that as well. So these are all kind of similar ways to express the same underlying investment theme, I would say.
Okay. Yeah, that makes total sense, and that sounds great. Well, Ben, where can people follow you? Obviously, subscribe to the Substack and such. Give the audience that information.
Sure. So the best place really is on Substack. I am on X, but I try not to use X too much, to be honest. Substack is the Royalty King. That's the main research-focused Substack. There's a free aspect, and then there's a paid aspect, not very expensive. And then I've just launched another Substack focused on derivatives and exotic trades for income and speculation. So that's called Machina Capitalis. This is the way that it's a one-man insurance company, basically, where I can take anywhere in the world and have borderless cash flow generated by using some of the tactics that I mentioned in the publication. So thank you very much for having me on. I really appreciate it, and I hope that was valuable for listeners. Reach out if you have any questions. Happy to answer any questions that might come from the VRIC audience.
All righty, you all have the information. Be sure to hit the subscribe button. Love to have your support there, and thank you for watching.